Good morning, everyone. BOE, Bank of England, on deck. Blake made me aware of it. Interest rates spiking. Here's cable, Blake. Okay, selling off a little bit. I don't know what the announcement is, but I actually sold it. Faded a few things after the Fed yesterday. I'm still down 17 pips in cable. Would have been better off, of course, short in euro, but did short the S&Ps at 82 and probed the Canadian. Anything you want to add, guys, on what's happening in the BOE? Okay. So the dollar reverse course, pretty good. They slammed it here on the Fed. I think that this was maybe just a stop hunt. We'll see. Failed from 92. We've been talking about 92 all week. Over 92 now after a candle like this would be very constructive. Okay, so EG made a new low, and look at this, it's turning pretty good on the BOE. So I don't know what they're saying. If you want to interject, Blake or Stell, on the BOE, just go ahead and do it. And gold failed from the 1750 level. Okay, Jay thinks it's going lower. Maybe you're right. And here's an interesting look. I notice it's a pattern in play, but we had a throw over in Canada right here. Okay, yeah, yields spiking again, new highs and reversing now. Okay, so I was waiting for one more new high in the yen, and we didn't get it. Maybe we're not going to get it. It's possible. Yields no retreat. Yeah, look at the candle right here. Golly, we're already a couple bips off the high. I know it's short term. The daily looks, pretty amazing, but I think if you're shorting bonds here or any yield right now, that you're probably a little bit late in the game. So the S&Ps are trying to bounce, but you have a pretty negative setup here. It's trying to hold here. We take out today's lows. I was talking about that we could just have a pullback towards 3880 in the S&Ps. We'll see about that. And oil, not much of a reaction, kind of, since the break from Sunday night's action, kind of caught in between these moving averages. I don't know which way it's going to come out. I favor the shorts, but I wouldn't mind seeing another rally here in this. So I don't know about whether or not you could call this a fake rally. I think 1600, Khalid. Are you Khalid, my buddy from many years ago, going all the way back to FX Street? Just curious. You haven't talked to him in a long time. What did the Fed do? Okay. All right. Whatever the Fed did, the market liked it for a while. They came in, they're going to buy more bonds. They better buy more bonds because TLT is in, kind of a lot of trouble. You're taking out 200-week moving averages. I wouldn't fade it. Okay, good. So now I'm even on the pound. I'm bullish, the Dixie. You know why? I was in doubt yesterday after this candle. But when I look at this right here, let's go with a 4. What kind of high is this in the dollar? So I was conflicted coming in this week, but what kind of, because of this, I have no fundamental argument to give you, except that the last high at 92.40 was confirmed. And, you know, it doesn't always work, but there's a very high probability markets normally don't peak when price and momentum are confirming. Normally it takes new highs in price without momentum confirming, a few divergences before you get a good top. Okay, Ben Maldonado's here, stronger dollar. So, you know, I think we're going to, can I say it? 96, 97 in the dollar. I'll start thinking about throwing in the towel back under 91. Yes, I think we can have both. In fact, Ben Maldonado will say that you could have higher metals. Yeah. And the yields, I do think, are going to come down. Okay. I don't know the exact day, the exact minute. Maybe it's today. But, you know, we are confirming on many time frames here, except for some of the shorter term ones right here. They're all confirming. Unless you look at a 15-minute, and if you look at a 15-minute, what do you have here? You have 1, you have 2, and you have 3 up here, and look at this. So this is when a market can top. Not here, right? They're bouncing, yeah. I know, gold's only 13 lower. 1720 is a big area in gold. Maybe even lower. Maybe 3,000. But I don't think the S&Ps have topped yet. I'm just saying that this could be a correction in the S&Ps. And, you know, I know a lot of smart guys that, you know, are talking about the potential of 41 something in April. So why can't we go to 38.80, right? And then take out the highs, which would be about 120 handles. And you had 120 handles over yesterday's high. It gives you 41.05. April, May. In fact, also another very good analyst, Peter Goldstein, got a hold of me, and he thinks trannies are put in a wave 5, and he thinks the market's going to top mid-May. So, you know, could turn into a sell in May and go away. And Peter will be with us on the 14th. So when he contacted me about what his work was telling him, I booked him right in that time zone. So that's still a couple months off. We could definitely see 4,100 by then. And what's St. Ledger Day? Anyway, I had my second shot. I have chills today and body aches. I am having a little reaction to it. But while I was getting a vaccine, I asked the people if it would inoculate me against losses in the market, and they said no. It's not going to inoculate me from making mistakes in the market. Oh, okay. Thanks, Galaxy. Anyway, Blake, how are you today? What do you think of what BOE did? Obviously, the pound's under a little bit of pressure from where it was earlier.
It is. I mean, they basically. I mean, they left rates unchanged, but they said that they weren't going to even think about raising rates until they start to see some inflation. So, I mean, it's the same. It's the same story as
they all say that now, huh?
I'm
it's
sorry?
Like a global central bank theme.
Yeah, you know, what I you know, talking about you know, yesterday and the Fed yesterday. I mean, I walked away and I thought, man, that's such horse crap. I mean, and it's, you know, the reason why I say that is that the Fed raised its GDP forecasts, yet, here we are, he's just singing dovish, everything's going to be, it's, transitory and blah, blah, blah. Yet you have other central banks that are really, starting to be more hawkish. And so there was somebody that made a comment yesterday that, when he was reading, he was like reading verbatim his answer,
Oh,
so
yeah.
he doesn't get sidetracked. And it's like, I mean, that's, in my opinion, the market is kind of sniffing this out, and that's why yields are moving higher. And that's the thing.
Blake, you and I have been around long enough where the Fed didn't care about the market. It was about Fed policy. I've never, ever seen a Fed more sensitive to the S&P, ever. He's so worried about some type of sell-off in the S&P. I mean, every Fed chairman, even when the markets were under pressure, really weren't as sensitive to what the stock market was doing.
Well, it's truly, and I have to say this, it's truly the wealth effect that you got, that they are really relying on. I mean, it is the trickle down economy. And I know you guys probably haven't heard that in a while, but it is a thing. I mean, it is. Look, if I'm a billionaire, because millionaires don't even matter anymore. It really doesn't. Oh, you're a millionaire? Ooh, look at you. We just created 600,000 new millionaires here in the last year. So what who cares? No, but no, seriously, if you're wealthy and you've got some money and you feel wealthy, you're going to spend money for the most part. You're going to go to the stupid store, which I shamelessly, I mean, I actually own a piece of furniture from there, but you go to Restoration Hardware and you buy a $12,000 couch, and the salesperson gets a commission on that $12,000 couch, and then that salesperson buys dinner at some restaurant, and then tips some waiter really nice. I mean, it's just the trickle down economy. I mean, the trickle down effect. So there is, it is a real thing. And I believe they believe in it because it's, again, and one of the other things about what the Fed's doing, it's all about psychology. And this is managing not only, the trickle down economy, if you will, but also managing the, inflation expectations, which, as many of you probably know, inflation expectations are a bigger fear of the market right now than the Fed or than COVID, at this moment, which makes a lot of sense to me as well. But look at yields, and this is the 10-year, and the 10-year, you'll notice we're really close to a 175. Actually, we went as high as 175.30 today. I was reading this analyst this morning who said we have to watch the 170. Let me read his comments here. Where is it? Just give me 1 second. And maybe Stelios and Steve might have something to mention regarding this, because this is really interesting. Everybody's worried about 1.5%. He goes, the S&P has absorbed the massive year-to-date spike in the 10-year Treasury yields as investors rotated rather than exited stocks completely. But this will change as the number gets to 1.75, beyond which real rates start shifting into positive territory. Okay, so what he's saying? Oh, go ahead.
I've said that many times in the past, and I've explained why it happens. Real reported rates are shifting to the positive because real rates are nowhere near that, unfortunately. And we all know it. We all witness real inflation daily. We know that it's not what they're reporting. I've explained in the past that through the mechanics of hedonic adjustment and substitution, unfortunately, the government and the central banks, because it's not only the Federal Reserve, are working hand in hand to, one, underreport inflation, so the other can claim we don't have a lot of inflation, so they can keep on printing money. And real market participants, the smart guys, because we know that the bond guys, people like Gundlach, etc., they're the smart guys. They know economy, they know real rates and all that. We know that these guys don't go for it. I mean, Gundlach knows what is the real, inflation or the reported inflation. I mean, Blake.
What's your guess, Steve, for real rates not being nominal anymore? Where would they have to be?
I can't speculate, but I would have to say definitely north of 3 or 4%.
Okay, thank you.
All right, so we're seeing the 10-year, and thank you, Steve, for that explanation. And I agree with you. I think that the especially the bond kings, they know and they're watching. And here's the thing, you have yields that are stubbornly moving higher, and there's a reason for that. Another reason for that, obviously, the Fed really told us yesterday that it doesn't matter. That yields are going higher, so they're not going to stop. They're not going to try to stop the fall in the bond market right now, because they feel that the rise in yields is also representing the strength or a perceived strength in the economies. Yet they're so dovish, and I just sat there and was looking at him going, how can you be so dovish? And you just raised GDP forecast. What'd they raise it from, guys? What 4.5 to 6 point something or other? Well, I forget what the actual measurement was.
I think like 6.2, 6.5, something like that.
Oh, here we go. From 6.5 GDP growth. Okay, that was. You got to be watching the Aussie here, because the Aussie actually, I want to show you guys this. We reached for the 618 retracement yesterday, so that was going to be resistance, which just irritates me to all get out. The high was 78.49. I have an order. It is at 56, and I didn't get triggered last night. I'm very irritated that didn't happen, but you'll notice that as a false breakout above those highs, hit the 618 and we reversed. So but anyway,
great call, Blake, on saying that you're always better off in this environment right now shorting NASDAQ rather than S&Ps, and that it failed from 61.8. It tried the 61.8 again yesterday. I was thinking about you, and very good call on that, man.
Well, I wish I was trading better than my calls, and because I actually, last night I've been short the euro yen, sitting in a euro yen short around these levels. And last night, I mean, it's hard when you have the FOMC lied right in your face, equities rally, and you're like, gosh dang it. And I know the euro yen's up against really key resistance, and I closed out for a loss last night because I'm sitting here going, okay, here we are at this multi-year trend line. We're probing these highs, and it's like, okay, I'm going to take my, for me, it was like a 30 pip loss on a trade. And I knew we're probing against big multi-year resistance, but it's also, okay, the Fed just did meet. How about what happens if, they shove this trade, so far up my rear end that I don't even see the daylight tomorrow, and I'm like, I just didn't want that to happen while I was sleeping. So I'm like, well, I'll sleep better tonight knowing that, I'm not in it. But, you have to make these tough decisions sometimes in the market. So I wish, for me, I was trading a little bit better than I actually make that call. But I do believe that NASDAQ will continue to underperform. I think technology, as yields go higher, they're gonna take the crap out of tech. the guys, you know, a lot of guys that I know and that are trading this market, they went home long bonds and they went home long equities, and they're getting up this morning going, holy you know what I mean?
Yeah.
Like wrong sided big time. So think about that. As you go through today, there's a lot of people that were like, I'm going to get long bonds, right? I'm going to get long bonds because they can't go any further. Because we're going to have a rally in stocks and yields are going to come down, and the stock market, you know, they you know, got long equities thinking, hey, this is a straight shot to 4,000.
Right.
And you get up this morning and you're like, whoa, what happened?
There goes your week.
Yeah. So, hey, Stelios, Steve, good morning, guys. How are you?
Good morning, mate. Good.
Good morning.
Hey,
Hey guys.
Hey.
I'm inoculated.
Oh,
Good
yeah.
stuff.
Congratulations.
Good stuff.
Dale, you know what? Here's the thing, and I'm going to say this from.
I could kiss you now.
No, this is my.
No offense,
What?
coach, but no thanks.
I got to say,
right.
I'm still straight.
Let him speak. Go on.
Yeah, let me finish up by saying this. I've seen there's still a lot of COVID variants out there, and
I know
my mother-in-law, she's a physician, right? She's like one of the first, because she works with COVID patients, one of the first to get vaccinated, and she's just like, look, just because you're vaccinated doesn't mean that you're immune. And it's just a level of protection. And it's scary because I go to the grocery store. I purposely like to go to the grocery store because for me, it's getting out of the house and it allows me to just mingle with people. Right. But what I've noticed, and I live living in Scottsdale, Arizona, it is a more of a retirement community because it's beautiful here most of the time. And you know, it's sunny all the time. And, you know, so we do have our and especially in where I live, it's going to be more
snowbirds.
We get snowbirds and, you know, people that have retired here, and, you know, but the thing that I've noticed is going into the grocery store over the last like few weeks, I've noticed less and less people wearing masks. And I'm like, oh God, you know, and I worry. And I'm watching this, you know, I'm watching these 67-year-old people without masks. I'm like, you know, I'm happy for you that you're vaccinated, but I don't know if it's, you know, I just hope for the best.
I've had this conversation with one of the researcher doctor friends of mine, and he's explained that, and trust me when I tell you, he's a very conservative type of doctor. So very conservative. Although not old in age, he has always been, you know, very careful, very conservative. He's the one that has, in essence, been giving me the guide of how things are going to go, and so far he's been on point to, you know, everything. So he's told me that, you know, it's a little bit of scare tactics because they don't want people to go gung-ho. He's explained to me that actually vaccination doesn't only protect you from contracting the disease,
but giving it.
Which, as you said very, very correctly, Blake, there are strains that vaccines work less to do that job. But he's also told me, which is very important, that the vaccine actually protects you if it fails to prevent you from contracting the disease. It's still not like you contracted the disease without being vaccinated, because now that you've been inoculated, your body that knows the general description of the virus itself, even if it's a variation of it, that it doesn't prevent you from contracting it, it now is able much faster and much sooner and much more efficiently to fight it. So if you are the unlucky guy or girl or gal that, you know, a vaccine fails to prevent you from contracting the disease,
you won't end up dead or in the hospital.
Still your prognosis after contracting it is 1,000 times better than if you never had the vaccine. So in essence, it's protecting you in two different ways. One is not getting it, but second is even if you get it, your prognosis is much, much, much better.
Yeah.
Yeah, well, just I guess the point I wanted to make here, and thank you, Steve, for that, is just be careful. Hey, let's talk markets really quick because we only have a few minutes before the guest your guest arrives, Dale. So how do you guys feel about yields? I mean, we have the 10-year and the 30-year, or Stelios, I haven't heard your opinion on yields with the overnight move in the market. What do you make of that?
Well, it seems that the breakout is sticking, and we're grinding higher. So yields are going higher. Equities still don't look like they're reacting much to them. But I think that the more these continue, the more probable or definite I probably would say that we're going to see a reaction. Eventually, we're going to see a reaction from equities. Is it going to start today? I don't know, but we've broken out. It's as simple as that.
Right. Okay. Well, let me point out a couple other things for you guys. Again, I want to talk positioning a little bit because, you have people that last night, they're like, oh crap, they're going to rip the market. So I'm going to get long NASDAQ, or I'm going to get long S&P, and the S&P, as we're pushing in Asia up into new highs, or I'm going to get long the Dow. And by the way, the Dow, just so you guys can see here, is an AB equals CD, 161% extension. I'm not getting too excited about equities yet, but we are seeing a divergence where some of these dollar pairs, like you take the I know I've been watching the US dollar Norwegian krona a lot recently. Dude, it hasn't gone down. You know what I'm saying? I mean, and by the way, Norway came out and they are positive. Right?
They push forward their projections for the next rate hike.
Yeah. So I mean, and it's not giving Norway the krona any strength. So you still see these divergence in these currencies, and so I think you have to be really careful. Coach just said, I think the dollar index could hit. What'd you say, Coach?
96.
Yeah. Okay. 96. I mean, that's, if you're a dollar bear, you don't want to hear things like that, like projections out to those levels. I saw a lot of dollar bears get really excited last night in Asia. A lot.
I think, Blake, that the market is sending a very clear message to the Fed. We got a very, very dovish message yesterday from Powell, so he did his part. But the market is now saying, show me the money. Like, okay, you're saying so on and so forth, but we know that there is no demand for bonds even at these yields. So show me the money.
Yeah, the bond vigilantes are out
show
there.
me that you're actually going to soak up all this supply, which I think they eventually will. But the market will first challenge them, as it seems, to do so.
Yeah, right. So how do we what do we do here? What's the plan of action moving forward? What do you guys think?
I think that if first of all, it's interesting that as many times the initial move yesterday was the wrong one, right? Having to do, with yields, equities, etc.
Yeah.
Which puts the market in danger of seeing an acceleration higher in yields, and I think that the stock market will almost be impossible to keep ignoring it for much longer. That's what I think.
Okay. And let me point out one other thing, and one last thing before I let you guys before Dale takes over here. So if you look at volatility, everybody was so excited last night. I mean, yesterday at the close.
For the lower low.
Oh yeah, we got volatilities back below 20. S&P looks like we're going to 4,000. And the VIX was below 20, and it would look like, hey, maybe the VIX is finally going to play catch up and get back down into the teens. But if you look at the DSI and volatility, and let me see if I can pull that up for you guys really quick.
Yeah, was it 10?
I think it was 11. Or maybe it was 13. So it's low. Let me see what I guess it'll pull up here. Let me see here. The DSI is for volatility is 12. So, you know, you got volatility DSI that's at 12. And by the way, bonds, you know, on like the 30-year, the DSI is 13. So, you know, you got DSI, which is very, 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 you know, pretty extreme at this point. So there's a risk now that we can start to see the, you know,
and still never filled that gap all the way back there in 2020. It's filled at 1820, the gap to your left, Blake.
Right here?
Yeah, never filled it.
Yeah, no, it hasn't.
With
I
new
think,
all-time highs.
well, I think a lot of people are probably, you know, waiting for it.
Guys, we got data, by the way. Philly Fed, huge bit, 51.8 versus 23 expected. Initial jobless claims worse than expected, 10% worse actually, 770 versus 700. And previous one revised a little bit worse as well. Continuous jobless claims higher as well at 4.12 million, almost 4.13 million. That's it. That's the data we just got. And Canadian housing price index.
Our guest is here.
Oh, your guest is here. Okay, so when you one last thing, and then you know, just looking at the data. So the data that you see here on Data Flash, Philly Fed, strong data. You know, jobless claims are basically in line. I mean, that's the way you kind of look at it, is they're in line.
Yeah, but still the number is huge, historically speaking, right? I mean, Blake, we still, after so long, we're still getting initial jobless claims weekly worse than the worst print we got during the Great Recession.
Yeah.
And it's been now a year, right?
Right. And, but good news is, Amir in our chat room just said that he got his stimulus payment today. So woohoo! All right, guys.
Oh yeah.
Hey, all right. So
Dale, buy some GameStop calls.
Yeah.
Hey, you guys have a great one. And Dale, we'll let you take over here so we don't take up any more of your time with the with your guests. But just want to mention, please visit our webinar sponsor. They make this happen. Pepperstone Securities. Go through our website here, ForexAnalytix.com. Go through where it says Forex Analytics sponsored. You can get up to 4 months for free if you open a live trading account with Pepperstone Securities. Learn about it here. You have to click this link here.
And if they're from US and Canada, they can browse lower, you know, for Forest Park effects. Yeah.
Yeah. Oh, great. And yeah, if you are in the US or Canada, talk to Forest Park FX. They will hook you up and find you like the best broker based on your needs. I can't tell you how many people we've sent over to them over the years, and people come back to us and say, man, that was
not like, one person has ever complained or told us anything but the best
service, guys. I mean, you know, they're like, okay, what are your needs? Let me find somebody that's going to meet your needs. So anyway, all right, I'm going to let you go. Dale, thank you so much. Steve, Stelios, thank you, gentlemen, so much. And
thank you, Blake.
Yeah, we'll see you guys later.
Good hunting, team.
Thanks, guys.
All right, listen, Robert, how are you? Welcome to FaCe.
Can you hear me, Dale?
Got you, Robert. How are you?
Good, man. How about you?
Good. I wasn't sure you were going to show. I'm glad to meet you. Have you used share screen, Zoom before, and are you going to share your screen?
You know what, Dale? I don't really have anything to share screen-wise, if that's okay.
That's fine.
You can use your camera if you want to have a face-to-face as well. That's also an option if you wish.
Well, no, it's with this whole COVID thing, I'm not dressed for that. Thank you.
All right, buddy. So, you know, I'll flash around to different markets. Where I usually like to start, Robert, is ask people about their journey in the business and how they got started and who they blame for influencing them to become part of to Hotel California, where you could check out but never leave.
Certainly seems that way, doesn't it?
Have you tried? You know, I put out a tweet. It's like being in the mafia or Hotel California.
Yeah, I don't get much further than 1 foot out the door and I'm back.
Yeah. even when I was doing other things, I was always had an eye on the market. So tell us about, you know, I read a little bit on your Twitter handle about that you used to be a bond trader, etc. And tell us about your journey and, you know, what you were thinking you wanted to do maybe in your early 20s and how you ended up here.
Fair enough. I'm going to try and divide this interview into two.
Okay.
Let's begin with the beginning, where how I got started, as you asked, at least in the world of institutional trading. Fresh out of high school, I knew that I had no interest in pursuing a formal education. I had always been fascinated by, I'll call it the stock market at the time. I got a job working the blackboards at a foreign exchange money market brokerage called Eurobrokers Harlow. I don't know if you're familiar with them.
Okay. Yeah, well, I'll tell you what, I share a blackboard experience with you because when the IMM opened, the gold contract was active, but they were trading currencies on a chalkboard.
All right.
So, yeah, and I was at the CME, so
okay.
Yeah, I remember that.
So my job was to post bids and offers from banks from around the world who would borrow and lend in the Eurodollar market. So I spent, I don't know, the first 4 or 5 years of my career on the street with them. I got to the point where I was responsible for the Eurodollar desk, which I don't know how many people at the time there were, but there were at least a couple dozen. It was a pretty sweet gig. I mean, I had clients all over North America, the Caribbean.
Where were you, in New York? What was that where it was happening, or where was the location of this
This
place?
was in Toronto.
Oh, okay. All right.
So things were going great. But when I was young and dumb, everybody wanted to be a bond trader. And I decided that I would open up an account with, I think it was Merrill Lynch, and start trading some bonds on the side.
Was that during the Milken era where, you know, bonds and, you know, were much more popular instrument than equities?
I don't know, Dale. I mean,
okay.
I mean, I really can't say.
All right.
But for some reason, it struck me that the place I wanted to be was on the bond side or the fixed income side of the business. And like a lot of people, I got really lucky with my first 3 trades. They were all positive. I didn't have any technical indicators or anything really. It was just feel. I made the mistake of, I guess, over cocktails with my boss, mentioning to him that I had done this. He called me into his office a couple of weeks later and said, you know, we've got a contract. It's sort of a 6-month, you give me notice, I give you notice. And he said, given that you're talking about becoming a bond trader, maybe you want to sign this piece of paper that basically it lets you out of the 6-month clause. I don't know, I was 24, 25, so I thought, sure, sounds like a good idea. But a week later, he called me in and fired me. And that was like a day before bonuses and whatever else, and showed me the door. So I thought, okay, well, I've come this far. I do want to become a bond trader. So I went out knocking on doors and was riding the elevator down one day from I don't know where, and there was a gentleman in the elevator who looked at me and said, I know you. And I introduced myself, and he said, listen, I know too, Robert, and one works for me in London and the other used to pump gas into my boat up at my cottage. He said, "You've got to be the guy that pumped gas into my boat." I said, "I am." He said, "Well, what are you doing here?" I told him I wanted a job as a bond trader. He said, "I run the money market department of a large brokerage." He said, "Why don't you come with me and I'll introduce you to the heads of the sales and trading departments in our bond department." So off I went. And about, I don't know, a couple of days later, I ended up on the sales desk of a large institutional bond firm. I was, I don't know, at least 15 years younger than everybody I was working with. I was handed a list of clients and told to, see if I could drum up some business.
Yeah. How'd you like cold calling?
Well, it wasn't really cold calling. I wouldn't describe it that way. It was basically, trying to, I thought foolishly, it was trying to provide better bond prices. I learned many years later that the business I was in was not the bond business. It was the relationship business.
Everything is a relationship business.
Lucky for me, I ended up with an account that was doing quite a bit of business with me. And after about 6 months, this large American bank said, "Listen, we're looking for a new trader on our bond desk. Why don't you join us?" So I thought, great, here's my opportunity to become a trader. So across the street I went. The bank was basically using bonds as a hedge for their interest rate swap program. And they had a book of, I don't know, a couple $1 billion worth of swaps. So I sat in a desk where I was hedging, I don't know, 200-300 million of 10-year notes on a daily basis, almost, it would seem. And in the mix, I was using bond contracts as a way of getting the bonds themselves off the balance sheet. So I had what I would describe now as another sweet gig, and a boss whose idea of a busy day was grabbing his squash bag at 11 in the morning, and I would follow him out of the office. We'd play a game of squash, and at lunch we'd be out for drinks and lunch, and we might get back to the office at 2. This went on for, I guess, 4 or 5 years. At the end of it all, the book was moved to London, and I wasn't offered a ride on the plane that took everybody else over to London to continue the business.
It's really, I'm listening to your story, and it really is a tough arena where it ends up being harder to trust people, their words, their contracts, everything. I think that anyone that's been in this arena for any period of time, ends up being pretty skeptical about what people say or write or anything. And, in this business, having a relationship for 4 or 5 years is almost eternal, isn't it?
Yeah, I suppose.
And where you could count on the people.
I enjoyed the people I worked with, and I took the attitude that everything happens for a reason, and there's a greener pasture, waiting for me. So it didn't come as a big setback, I don't think, at least not emotionally.
All right.
So I had done quite a bit of business with the sell side of the street when I was hedging this portfolio at the bank. So I had some all right relationships with the folks on the brokerage side, or on the sell side, I'll call it. So off I went to, I can't remember. I think a bunch of us were going to Chicago for some function, something not to do work related, but the guys I was going with had never been onto the floor. So I had relationships on the floor. So I took them down to the Merc and showed them a good time, or we were all shown a good time by the folks down there that I knew. And I got a phone call out of the blue from a headhunter who said, listen, you're going to have to get on a plane. I got 2 interviews set up for you. I didn't even know this dude. And anyway, I ended up with a job at a large American brokerage on the sell side of the street now. Initially, they wanted me to go off to Japan to represent them on the non-dollar side of the business. That never happened. I ended up with a portfolio of strip bonds, as it turns out. I became their strip bond person. I should sort of step back a second and say that both my experience on the buy side of the street at the bank and on the sell side at the dealer, we never used, and I mean never used, any form of technical analysis to make any of the decisions that we were making concerning our portfolios.
What did you use?
We didn't. I mean, it was very simple. When I was at the bank, if I needed 10-year bonds to hedge my portfolio, I needed 10-year bonds, and
you weren't price sensitive.
I was price sensitive from the point of view that I knew that if I was able to get bonds in under whatever the price was, that I was doing my job and I wasn't losing any money. But at no point in time did I pay any attention to any lines in a chart, to any retracements on a chart, to any chart, period, really.
How about now?
Well, this is we'll get to now.
Okay.
But I'm going to sort of go back to my stint on the sell side of the street. When I was, and I had about close to $1 billion strip bond portfolio that I was responsible for. When a client was buying or selling, and I needed to unwind a hedge, I was never, and I mean never, looking at a chart in terms of where there might be support, where there might be resistance, and neither were any of the other guys on the desk. We had a couple of proprietary traders and a few analysts who specialized in things like Elliott Wave, et cetera, but 99.9% of the time, whether I was a buyer or a seller, was driven by flow. Meaning, the client wanted a particular security. Either I had it or I didn't have it. And if I had it, I was selling it to him. And if he was looking to sell a product, I was putting it in my book. And I was either hedging it with a security from the same part of the yield curve or another part of the yield curve. But the idea that where I was going to buy or where I was going to sell was going to be driven by anything other than supply and demand just didn't exist. I mean, it just did not enter the realm of have you considered this. On both sides of the street, at the end of the day, I mean, 95% of us would go home flat. And by flat, I mean hedged. We didn't have an opinion as to whether, the market as a whole, or let's say 30-year bonds, 10-year bonds were going up or down overnight or tomorrow or the next day or next week. We had a view on the curve, and we would hedge our positions based upon a flattening or a steepening yield curve. But nothing technically related, nothing at all. And the clients that I dealt with and the sales force that I spoke to, people were really not paying any attention to technicals. There would be situations where you'd come in the morning and bonds would have left the street overnight into Tokyo, into Asia, into Europe. The street would be short. You would get a feel for, which way the street was leaning. And when I say, I'm referring to the cash bond market, not the futures. And of course, the futures, as far as I'm concerned, follow the cash bond market, not the other way around. But the street would naturally need product. And if everybody or 90% of the street was in the same boat, prices went up. And everybody was chasing everybody to get inventory in. And that would include the futures. The futures would be going up because the cash bond market was going up. And if you stopped at the end of the day and sort of thought to yourself, well, what happened? Why did the bond market go up? You could listen to a news network. You could look at technicals. You could do whatever you want. Everybody's got a reason or a story to tell you about what happened. But you know what happened. You know that there were more buyers than sellers. You saw the buyers come in. They came in first thing in the morning in Asia, later on in the evening in Europe, and that buying continued. And that buying had nothing to do with where the market was technically. It had to do with people needed product. And anyway, so I don't know, I lasted, I guess, close to 10 years with this large American institution. I thought I was doing really well there. Every year, a group of us would go down to a buddy's place in Long Island and go deep sea fishing for tuna off of Montauk. This particular year, I decided that I was going to go, but I wasn't going to go on the firm's dollar. I was going to do it on my own for reasons that I don't quite understand. I went ahead and did it. Turns out that the new chief at the company wasn't impressed with my decision. In fact, according to what I heard later, he was out with his buddies who were all heads of bond departments on the street. And the question came up over, anybody from your bond desk going on this trip, fishing and golfing? I think we used to play golf at the National. And a few years we played at Shinnecock. So it was a well rehearsed outing. And anyway, he said, well, nobody from my shop's going. And somebody said, well, as a matter of fact, Robert is. This upset him a great deal, to the extent that a couple of weeks later, he called me in and he fired my ass because I put him in an awkward place. So from there, I spent another 5 or 6 years at, I'll call them B-level firms. And then I went on to trade for a couple of hedge funds. When I got into
Robert, we only have about, we have a few minutes left. With all the experience that you have told me about and being around the bond market as long as you have, what do you think about the recent huge spike in yields that we've had over the last couple of months? Long lasting or temporary blip?
You know what, Dale, I don't have an opinion, but I'll quickly get over to where I wanted to get, and I probably should have been quicker. I didn't realize how much time we had. When I was on the institutional side of the business, we were responsible for moving the markets, I'll say. I wasn't dependent on anybody else to make me a winner or a loser. I've been on the retail side of the street now for, I guess, almost 12 years. And for the first 9 years of that, I couldn't make a penny trading for myself. But what I came to learn was that on the retail side, as a technical trader, I'm completely dependent upon others to make me a winner. Others have to come into the market after me and either buy higher than me or sell lower than me if I'm short. And it took me a long time to understand and to reflect upon order flow and how things work on the retail side of the street. It is the complete opposite of what I learned on the institutional side. And it took me
when the trading floors closed and a lot of guys made money just trading the paper or filling orders, they couldn't make the transition to trading off the floor because they never traded. They, where they were taking positions and speculating on direction. They were just, they're functioning as an order filler or trading off the paper. And a lot of people had a hard time reinventing themselves now that all the trading floors are bowling alleys.
So relying 100% on other people to make me a winner or to or to make me a loser has proven to be a difficult journey. But what I did come to realize is that if I want to be successful as a passive retail trader, technical trader, I have to start thinking like a casino operator. There is no way that any technical edge is going to tell me what's going to happen on a trade-by-trade basis. But over a series of trades, and in my case, I use a series to mean 20 to 30 trades, I can and do tilt the odds in my favor. Now, trade by trade, no idea. It's a prediction, it's a guess. I don't know if I'm going to be right or wrong. But over a series of trades, I've proven that I can be consistently successful. And it's a totally different way of thinking than it was in my previous life. I am completely dependent upon others, which I've never been before, to make me a winner. It's been a truly an unbelievable journey to go from one side of the street to the other. The two are not connected in any way, shape, or form, in my opinion.
Okay. Well, very interesting story and interesting way of looking at it, depending on others to make money. I mean, the market has always been filled with speculators, hedgers, institutions, retail. So, that's what makes a market. And I do appreciate you coming on and sharing your story with us very much, Robert. Thank you.
Okay, thanks.
All right. So that's going to be a wrap. And Robert, do you do anything where you'd want people to follow you or interested in that?
I've got a story to tell. I mean, if people are interested and want to learn about what I've learned during my journey, they're welcome to reach out to me on Twitter. But I don't spend a lot of time trying to sell anything or promote anything, Dale.
Okay, so here's Robert's Twitter handle at RemTrade, Paradox Trader, and I hope you stay safe and that people come through for you, and you have a great year, Robert. Thanks for your time today.
Thank you,
buddy. You're welcome. Adios. So everyone, that's going to be a wrap, and you could join the Morning Edge in 17 minutes, and we'll wrap up the week together tomorrow in Face. I believe Steve Volge has a special guest for us tomorrow. So remember, don't just count your bonds or your gold or your stock indexes. Count your blessings, and we'll see everyone tomorrow. Adios,
Bye-bye, Coach.
Warriors. See you, Steve.
Bye-bye, everyone.